So imagine you're at the gym, right?
Mm.
And you step onto a treadmill.
Okay, yeah, I can picture that.
You punch in this really comfortable, easy walking pace. Your breathing is steady, your heart rate is totally relaxed, and you feel entirely in control.
Right, you're just getting warmed up.
Exactly. But what you don't realize, and this is the scary part, is that the machine is programmed to increase the speed by a tiny, almost imperceptible fraction of a mile per hour, like every single minute.
Oh, wow, so it's sneaking up on you.
Yeah. At first, you don't even feel it. But 20 minutes later, you are suddenly jogging. And then 30 minutes later, you're on a full-blown sprint just to keep from being thrown off the back of the belt.
That is a terrifying situation to be in, especially if you aren't prepared for it.
Right. You thought you were maintaining a safe, steady pace, but the environment around you was quietly accelerating the entire time.
Because your perception of safety, like the idea that you were just walking comfortably, was a complete illusion. You were focusing entirely on your own feet, but you were completely ignoring the actual mechanics of the machine you were standing on.
And that illusion of safety is exactly what we're dragging out into the light today. Welcome to today's deep dive. We are exploring the foundational concepts from Gregory Scola's audiobook, What Am I Learning About Investing? Part 1.
It's such a crucial topic. The gap between how we intuitively feel about money and how it actually works is just huge.
It really is. So our mission today is to completely demystify wealth building. We're going to solve this massive, almost invisible mystery of the money that quietly disappears from your life while you think you're playing it safe.
Yeah, we're talking directly to you listening right now.
Exactly. Whether you are a complete beginner who is genuinely terrified of losing your hard-earned money, or you're someone trying to optimize your financial future, we're going to fundamentally reframe how you view money, time, and especially risk.
Because most people are honestly operating on completely outdated hardware when it comes to financial psychology.
Okay, let's unpack this. Because to close that gap, we first have to burn down the Hollywood myth of what investing actually is.
Oh, the Hollywood myth is so damaging.
Right. When the average person hears investor, they picture like a guy with his sleeves rolled up staring at 6 computer monitors.
With all the blinking red and green numbers.
Exactly. And he's aggressively trying to predict what some obscure tech stock is going to do by next Tuesday. We are conditioned to think success requires this hyperactive intellect and like a crystal ball.
Mm.
And Scola admits he fell for this exact same trap.
Well, the media certainly profits from portraying it that way. It makes it exciting. But the data, the historical records, and the reality of the greatest investors point to a completely different skill set.
It's not about being the smartest guy in the room.
Not at all. The secret weapon of wealth isn't an algorithm. It isn't a genius level IQ. It's actually incredibly mundane.
Wait, really? Mundane how?
It's patience. It's ironclad discipline. And above all, it's the mechanical ability to manage your own psychology. The great investors win not by outsmarting the market on a Tuesday, but by deeply understanding how time and human behavior interact over decades.
Which brings us back to our accelerating treadmill. Before we can even talk about growing wealth, we really need to examine how we are actively losing it by doing absolutely nothing.
Right, the danger of conscious inactivity.
Yeah. Scola lists 4 major excuses people use to justify just sitting on their cash in a standard checking account. First is a fear of losing money. Second is the belief that investing is simply too complicated.
Which is very common.
Very. Third is waiting for the magical perfect time to jump in. And the fourth is needing the money right now for daily expenses.
What's fascinating here is how deeply logical those excuses feel in the moment.
They do make sense when you say them out loud.
Right. They all stem from this evolutionary desire for self-preservation. Take the fear of losing money, for instance. You traded physical hours of your limited lifespan to earn that paycheck.
So handing it over feels dangerous.
Exactly. The brain perceives handing that money over to an invisible, volatile market as a direct threat to your actual survival. And, the financial industry actively makes things look complicated because complexity lets them act as gatekeepers and charge fees.
They profit off the confusion.
Huh.
But let me challenge that fourth excuse, though. The one about, I need the money now.
Go ahead.
That isn't just a psychological trick, right? That's a physical reality for a lot of people who are just dealing with rent and groceries. How does Scola address that friction?
He addresses it very bluntly, honestly. He argues that short-term thinking is actively cannibalizing your long-term survival. His rule is simple. Even if it isn't easy, you must spend less than you earn, save the difference, and invest it.
So it's a harsh truth.
Yeah. If you constantly use today's immediate friction as an excuse to avoid investing, you are actively choosing to sacrifice your future security. You're ensuring that you will never have enough money later.
Because doing nothing is not a neutral action. That is like the core message here. Not investing is an active decision to accept a guaranteed mathematical loss.
Yes, exactly. Scola calls this the leaping pound. It's inflation.
Let's break down that math because it's sobering. Let's say inflation runs at a historically average 3% annually. If you put 10,000 pounds in a standard bank account, in 20 years, the number on the screen might still say 10,000.
But it won't buy the same amount of stuff.
Right. It will only buy about 5,500 pounds worth of actual goods in the real economy.
Let's look at the mechanics of why that happens. Over time, the cost of raw materials, labor, transportation, it all naturally rises. A loaf of bread that costs £1 today might cost £1.03 next year.
Makes sense.
But fast forward 20 years, and that same single loaf of bread costs nearly £2. Your 10,000 pounds didn't technically disappear, but its purchasing power was functionally cut in half. Money has to continually grow just to stand still.
So leaving your cash in a standard account to keep it safe, it's like taking a giant block of ice and leaving it sitting on your kitchen counter.
Oh, that's a great analogy.
You might tell yourself, I haven't smashed it with a hammer, I haven't thrown it out the window, so it's perfectly safe, but you're completely ignoring the room temperature.
And the room temperature is inflation.
Yes. If you don't pick up that block of ice and put it into a freezer, which in this case is an investment vehicle, you aren't playing it safe at all. You are literally pilling up a chair to watch your money melt.
That perfectly illustrates the underlying flaw in how human beings calculate risk. Our brains are designed to detect immediate, highly visible threats.
So we look at the stock market and freak out.
Right. We see what Scola defines as short-term risk. You see the daily news cycle, you see a temporary 20% drop in an index, and that triggers a primal fight-or-flight response. The brain registers volatility as a catastrophic danger.
But wait, I gotta say, a 20% drop in your life savings is terrifying. If I have 50,000 pounds invested and I suddenly lose 10,000 in a week, my brain isn't exactly wrong for sounding an alarm, is it?
Well, your brain is confusing a temporary decline in pricing with a permanent loss of capital. That temporary volatility, it's entirely normal. It is literally the cost of admission to the market.
So what's the actual danger then?
The true danger, what Scola calls long-term risk, is completely ignored by our evolutionary wiring. Long-term risk is that guaranteed 45% invisible loss to inflation over 2 decades. It's the very real risk of waking up at age 65 and simply not having enough capital to survive without working.
Okay, wow. That puts it in perspective.
The experienced investor fundamentally flips this script. They willingly accept the short-term discomfort of volatility to completely eliminate the long-term catastrophic risk of running out of money.
Okay, I follow the logic. Keeping money in cash guarantees a loss, so we have to get it into the market. But that leads to this incredibly obvious problem. If we are putting our money into this volatile environment, how do we do that without feeling like we just walked into a casino? We have to fundamentally redefine what the word investing actually means.
We do. Scola points out that investing isn't about buying a 3-letter ticker symbol blinking on a screen.
Right. Let's ground this. You're buying into a company that has a CEO making strategic decisions. They have marketing departments. They have thousands of employees physically clocking in for shifts, building actual products, solving real human problems, and generating tangible profits.
It is a decidedly physical transaction, even if the interface you use is digital. When you buy a share of an index fund, you are buying a fractional ownership piece of a living, breathing business.
And when you purchase something like a global ETF, an exchange-traded fund, you are not betting your life savings on one single company trying to invent the next big thing.
To understand the mechanics of an ETF, think of it as a vast basket. Instead of buying one share of one company, you buy one share of this
But
basket.
inside the basket.
Tiny fractions of hundreds or even thousands of real-world businesses operating across the globe. You own a microscopic piece of the companies selling smartphones, the pharmaceutical companies, logistics, banks, everything.
So mechanically, how does that protect me from the casino effect? Like, what happens if one of those companies inside my basket goes completely bankrupt?
That is the mechanical beauty of broad diversification. If you own stock in only one company and it goes bankrupt, you lose everything.
Right.
But if you own an ETF containing 3,000 companies and one of them goes bankrupt, it is merely a drop in the ocean. The loss might represent like 0.05% of your total
Right.
portfolio.
Well, the rest are still making money.
Exactly. The other 2,999 companies are still operating, innovating, and generating profits that more than offset that single failure.
Here's where it gets really interesting. Once you internalize this concept, it completely changes your relationship with your own labor.
How so?
Think about your day job right now. Your physical income is entirely capped by the hours you are awake and physically able to work. There is a hard biological ceiling to how much you can earn.
That's very true.
But when you own fractions of thousands of global businesses, your investments begin working completely independently of your time. While you are sleeping, someone in a different time zone is buying a product from a company you partially own, and a fraction of that profit is flowing back to your bottom line.
This raises an important question regarding our earlier discussion about market anxiety.
Yeah.
If you truly understand that you are buying the active labor and innovation of thousands of people working relentlessly to grow their businesses every single day, why would you panic over the daily fluctuations in the stock price?
Because we are conditioned to treat the stock market completely differently than anything else in our life. I mean, think about how we act in a grocery store.
Right, if there's a sale.
If your favorite brand of coffee suddenly goes on sale for 20% off, you don't panic. You buy 3 bags instead of 1. We love a discount.
But in the stock market.
Exactly. When prices crash and these incredible, profitable businesses are essentially trading at a massive discount, we feel terrified, and our instinct is to sell everything. Conversely, when markets soar and become historically expensive, we feel like absolute geniuses and rush in to buy more at the absolute peak.
Human impulses in the financial market are entirely inverted. Both of those impulses, panic selling at the bottom and euphoria buying at the top, are mathematically destructive.
So how do we fix that inverted psychology?
The antidote is simply extending your timeline. Over a period of decades, the market ceases to be a volatile casino and becomes a relatively accurate mirror reflecting broader global economic growth. Populations expand, new efficiencies are discovered, profits rise.
And the investors who hold on get rewarded. Okay, I buy the ETF concept, I'm owning a tiny slice of the global economy, and I'm ignoring the daily price swings. But historically, the brawn economy only grows by something like 7 to 10% a year.
That's the historical average, yes.
Single-digit growth doesn't sound like it is going to make me wealthy in my lifetime. Am I missing a piece of the puzzle here? How does this actually generate wealth?
You are missing the most powerful mechanical engine in all of finance. It's what Scola refers to as a magical concept, though it's purely mathematical. We are talking about compounding.
Compounding.
Yes, compounding occurs when your investments generate returns, and then those returns immediately begin generating their own additional returns. It is growth, building upon previous growth.
I want to replace the cliche snowball rolling down a hill analogy here, because it doesn't really explain how the math functions.
Okay, what's a better way to look at it?
Compounding is more like buying a factory that builds robots. Let's say you buy a factory, and in its first year it produces 10 robots. But these aren't just any robots. They're only programming. Their only job is to immediately start building more robots.
I like this.
So in year 2, you don't just have your factory building 10 robots. You have the original 10 robots building their own robots. By year 10, you have thousands of robots building thousands of new robots every single day.
That is an excellent mechanical analogy for dividend reinvestment and capital appreciation. Let's walk through Scola's exact math to see how those robots multiply.
Let's hear it.
Assume you invest a single one-time sum of £1,000 and it grows at a very standard historical average of 8% annually.
Okay, I put in my 1,000 pounds. Let's track the timeline. After year 1, I have 1,080 pounds. I made 80 pounds. Nothing crazy. I'm not buying a private island with that.
Right. Now, after year 5, that initial investment has grown to £1,469.
And after year 10, it sits at 2,159 pounds. My money is essentially doubled. That is definitely nice, but it still doesn't feel life-changing.
By year 20, it hits £4,661.
But here's the massive leap. By year 30, that account is over 10,000 pounds. From a single, solitary 1,000-pound investment made 3 decades prior.
Look closely at the back end of that timeline. The growth from year 20 to year 30 alone is larger than the total accumulated growth of the entire first 20 years combined.
That is just wild.
As the surface area of your investment base expands, every single percentage point of growth represents exponentially more raw cash.
It honestly feels like a parlor trick when you look at the raw numbers. going from roughly 4,600 to over 10,000 in just that final 10-year stretch.
It does feel like magic.
Our brains feel like the math is broken because we are hardwired to expect linear addition. If I put one apple in a basket every day, I expect to have 30 apples in 30 days. We are not biologically evolved to comprehend exponential multiplication.
We literally cannot visualize how aggressively powerful the back end of that compounding timeline really is, and that cognitive blind spot is precisely why the vast majority of people fail to build substantial wealth.
They just don't wait long enough.
Exactly. They look at the math, they understand it intellectually, but they fail in the execution. Because the hardest part of investing isn't finding the perfect stock. The hardest part is enduring the agonizingly slow, incredibly boring early years of that robot factory.
When you're just making 80 pounds.
Right. For the first 5 to 10 years, your portfolio balance barely seems to move. You feel foolish, you get impatient, you want to touch it, you want to move it to a different fund or try a new strategy.
You want to intervene.
But the secret ingredient to compounding isn't finding a magically higher yield. The absolute non-negotiable secret ingredient is uninterrupted time.
Which sets up the final and perhaps most dangerous trap we have to navigate. If compounding absolutely requires uninterrupted time to function, what happens when we think we are smarter than the underlying math?
That rarely ends well.
Let me play devil's advocate for a second. If I know the first 10 years are slow and vulnerable to market crashes, shouldn't I just pull my money out when the financial news gets terrifying? Like if I see a recession coming, isn't it just smart damage control to move everything to cash and then jump back in when the dust settles?
Attempting to jump in and out of the market is the ultimate hubris. Scola makes it unequivocally clear, predicting short-term market movements is statistically impossible.
Even for the pros.
Even highly paid, full-time Wall Street professionals with supercomputers fail to do it consistently. And there is a staggering piece of data to back this up. Scola highlights a famous study conducted by Fidelity Investments that analyzes the catastrophic cost of market timing.
I remember reading this in the source material, and the numbers are almost unbelievable. Let's break down exactly how this Fidelity study worked.
The researchers looked at a 20-year period in the stock market. They tracked an investor who simply bought a broad index fund, went to sleep, and stayed fully invested for 100% of the trading days over those 2 decades.
And how did they do?
That investor earned 100% of this historical returns. They captured the full power of compounding. Then, they looked at an investor who tried to time the market to avoid crashes.
The one trying to be smart about it.
Right. In doing so, this active investor managed to miss just the 10 best trading days in the market over that entire 20-year period.
Let's pause and emphasize that math. Missing 10 days out of 20 years means this person was still actively invested for roughly 99.9% of the time.
Yes.
Surely their returns were almost identical to the first investor, right?
They were not. The investor who missed those 10 specific days earned only 50% of the returns compared to the investor who did nothing.
Only 50%.
Half of their potential lifetime wealth simply vanished because they were sitting on the sidelines in cash for 10 single days out of 2 entire decades.
How is that even mechanically possible? How do 10 days carry that much weight?
It comes down to the mechanics of how markets recover. Here is the crucial, counterintuitive data point that makes market timing so utterly dangerous. Statistically, the absolute best, highest gaining days in the stock market almost always happen immediately following the absolute worst, most terrifying days.
So when everyone is panicking.
Yes. When the market panics and drops 10% in a week, the eventual correction when institutional money floods back in to buy businesses at a discount causes massive, explosive single-day spikes.
So what does this all mean? It means that if you give in to your fear and you sell your investments during a market crash to protect yourself, you are mathematically guaranteeing that you will be sitting in cash during those vital, explosive recovery days.
Exactly. You are permanently locking in your temporary losses.
And you are entirely missing the upward surges that literally make up half of your total lifetime returns.
If we connect this to the bigger picture, the great relief hidden inside this terrifying data is that you do not need perfect timing to build wealth. In fact, attempting to have perfect timing is precisely what destroys wealth.
You just have to sit on your hands.
You simply need to buy productive assets and stay in the game. Time in the market will always mathematically beat timing the market.
It is so clarifying because it completely removes the need to be a financial genius. You don't have to predict the future, you just have to manage your own behavior.
And that's why Scola gives us tools to manage that behavior.
Right. As we bring this deep dive to a close, Skula doesn't just leave us with abstract theory. He provides 3 specific mechanical exercises to make this actionable. And I highly encourage you, the listener, to physically complete these today.
The first exercise is defining your investment purpose. You need to write down your precise why.
Like, what does financial freedom actually mean to you mechanically? Is it having the option to retire at 50? Is it generating enough dividend income to cover your mortgage? Or is it simply sleeping soundly without financial anxiety?
You have to write this down because this piece of paper is going to serve as your emotional anchor when the market inevitably drops 20% and your evolutionary wiring starts screaming at you to panic sell.
Exercise 2 is calculating your cost of inaction. We talked about the mechanics of inflation, but you need to see your own money melting.
Do the math yourself. Take a theoretical £5,000. Assuming a 3% inflation rate, calculate exactly what you are guaranteed to lose in purchasing power over 20 years if you leave it sitting in cash.
Schola gives a simple math formula for this. Take your starting amount, 5,000, and multiply it by 0.97 to the power of 20. When you look at the final number on your calculator, the idea of doing absolutely nothing suddenly feels far more dangerous than investing.
And finally, exercise 3 is the compounding commitment. Scola asks you to physically sign a quote.
What does it say?
It reads, I understand that compounding rewards patience. I commit to staying invested long enough to see it work. It's basically a binding contract with your future self to not interrupt the robot factory.
It's a promise to let the math do the heavy lifting while you go live your life. Well, that brings us to the end of our deep dive today. Thank you so much for joining us as we explored the underlying mechanics of your financial future. We hope we've helped you step off that accelerating treadmill.
I want to leave you with one final, lingering question to ponder as you go about your week. We've established that uninterrupted time is the absolute most powerful mechanical force in growing your wealth, and that investments are simply tools that work completely independently of the physical hours you clock at a job.
Right.
So, if you shift your entire focus away from the anxiety of trying to time the market and instead focus entirely on using the market to eventually buy back your own time, how might that fundamental shift change the way you design your entire life?